setting budgets and calculating payout points. So what is budgeting? Budgeting is the financial tactical implementation of a business plan. In this case, a media plan. To achieve the goals set in a strategic media plan, we're going to need some type of budget that finances the plan presented and ultimately sets measures and indicators of performance. We can make changes throughout the year to make sure that we arrive at the company's goals and even adjust the budget as needed and as circumstances change. Budget projections are extremely important and tied to the profitability of a company. In the world of advertising and marketing, it is also very volatile in the sense that it is the first expenditure that gets cut when sales go down. It is ironic because it's probably when advertising a product is most needed, but such is the corporate life. This is a very important part of a media planner's job, assisted by the media buyer. Remember that the media planner typically has more information from the client on their business goal, and thus they have to calculate how many impressions, how many exposures it's going to take to move the needle to achieve those goals. Once that exposure is calculated, it is time to calculate the budget or how much money the media investment will be. Budget setting is a step in media planning, and in this video lesson, we will look at 4 methods. So after you finish this video lesson, you will be able to understand typical methods of setting budgets, apply these methods to calculate how much media exposure and marketing in general to allocate, understand the correlation between a business objective, the media plan, and the costs associated to implementing that plan, understand the strategies and terminologies of setting budgets. Now, while this may feel like a business or finance lesson, most likely you understand by now that media is the platform to deliver an advertising or strategic communication message, which is part of a broader marketing plan, which in turn is part of a broader business plan designed to propel a brand into selling more. I consider any type of projections, whether they're audience projection, business projection, budget setting projection, a skill that is mastered through having the right data and as much cooperation from the client as possible. Remember that this is guesstimate work, which we need to base on a solid foundation of data in order to be as accurate as possible. Let's begin with the basic terminology you need to understand this lesson in setting budgets. Defensive strategy means that when the decisions and plans are set for that company or that brand, they're based on the objective of defending your market share and as a protection of their current business. Think defense of a market share. Offensive strategy is when the decisions and plans set for the company or the brand are based on the objective of putting money against where the biggest opportunity of growth is. Think opportunity. The marketing mix is a term created by the American Marketing Association back in the 1950s, but it's still relevant, to explain how marketers make important decisions regarding how they execute a successful marketing plan. A marketing mix is associated with 4 P's. You may have heard about it. Price, product, promotion, and place. Promotion specifically involves advertising, sales promotion, and public relations. And sometimes these 4 P's are expanded to 7 P's. In addition to the usual 4, the 7 P's adds the inclusion of physical evidence like packaging or a delivery receipt, people or employees that make it happen, and the process that impacts the product itself. Advertising versus promotion. What's the difference? Advertising is part of the P in promotion in the marketing mix, which involves paying for airtime space to promote a product, service, or cause. The actual messages are called advertisements or ads for short. The goal of advertising is to reach people most likely to be willing to pay for a company's products or services and entice them to buy. Advertising is done to build brand image and ultimately increase sales. Whereas sales promotion is push short-term sales. Both variables of the P in the promotion of the marketing mix, advertising thus has a long-term effect and sales promotion has more of a short-term impact. Let me give you a simple example. Drink Coca-Cola. That's advertising. Now, buy one case of Coca-Cola and get one free at your favorite supermarket while supplies last is an example of a shorter term promotional sales tactic. POP and POS, they can be used, interchangeably. This stands for point of sale or point of purchase, typically displays, and these are marketing materials or advertising placed next to the merchandise being promoted. These displays are generally located within the retail store where the purchase decision is made by shoppers. The goal is to encourage customers or shoppers to impulse buy through specific pinpointed retail merchandising. Variations can include in-store displays, posters, shelf talker. What's a shelf talker? These are printed cardboard, plastic, or paper ads or advertisements attached to the store shelf to gain attention of the shopper to that particular product exhibited on their shelf, on the supermarket, shelf. It can also include other variations, including digital versions designed to incentivize in-store sales or promote specific initiatives, all in store. Remember that everything in store is prime real estate, and every space used has a price. So let's define here, because this is they can be confused. What are objective strategies and tactics? And by the way, as a side note, I know a lot of professionals that still confuse the difference between objectives, strategies, and tactics. So let's define them right now. Objectives are basically your goals. For example, increase the amount each customer spends at a client's retail store, or increase sales by 10% over the previous year's levels. Now let's go to strategies. Strategies are the different ways or methods to achieve those objectives. For example, the company can increase customer spending through expanding product offerings or promotions or advertising or loyalty programs. Now let's go to the last level, which are tactics. Tactics are micro strategies that are quick, actionable plans that support an organization's overall strategy. For example, if the business goal is to increase sales by 10% over previous years, by using promotions as a strategy, the specific tactic can be to offer a loyalty program, which is a type of promotion that incentivizes repeat visits or spending more per visit. So for example, get discounted or free product or free shipping the more you visit and spend with that store. So the specific tactic is exactly what you're going to do to achieve the objective through the strategy outline. Again, the linear sequence is objective, strategy, and tactic. And every plan has to have those three outlined. Radio remote, what's that? Usually it's called a remote or a live remote. And this is broadcasting done from a location away from a formal studio, whether it's TV or radio, more typically radio. And it is sold by radio stations to clients, particularly those with retail locations, as a traffic builder. a radio station broadcasts live from a client's retail location, encouraging their listening audience to visit the store. Could be a car dealership, an event, a store, etc. Going back to payout point is the volume of product sales needed to pay for the advertising investment. In other words, how much more sales are needed and how much do those sales need to increase by in order to recuperate the budget spent in advertising. CPG. CPG is an acronym that stands for Consumer Packaged Goods, which is a category of client or companies manufacturing multiple products consumed by many people or consumers. The largest CPG company is Procter & Gamble, and they manufacture anything from dishwasher and laundry detergents to soap, toothpaste, disposable diapers, shampoo, skincare, and healthcare products, and all under very well-known brands. So now, we're going to look at 4 basic ways of setting budgets, or the amount of money that is needed to execute a media or advertising plan or a marketing plan. They are the objective task, the affordability, percentage of sales, and competitive spending. And we're going to look at each one separately through different scenarios. So we're going to be looking at different scenarios and parameters as guides to set budget using these 4 distinct methods. And by the way, they're not necessarily, detached from each other. It could be a combination of the 4. So now let's start with the first one, the objective task method. So the objective task method of budget setting can also be called the zero-based or ideal budgeting. And this is a method that I've used many times when I was working for a promotions agency. We specialize putting together sales promotion in-store programs using celebrities as traffic builders to meet and greet with shoppers and fans. And we announce these visits via the radio and television and other media. And we set up POS displays and other promotional materials in store to promote the products and also to promote the visit. To present the budget to my client, I use this objective task budget method, where I priced each tactic, I added the cost, I calculated the man hours or women hours, that effort was going to take, and the agency profit to build that budget from the bottom up. By the way, side note, the agency profit was a number that was given to me by my upper administration. So build the budget and then add X percentage. So we're going to assign a percentage here in this case scenario. So by starting with the objectives of the specific plan, you match the tactics needed to accomplish the objectives. The total budget is then quantified by adding all the total costs of the tactics needed and how the agency wants to present the budget to the client. By the way, the primary issue or problem with this type of budgeting is that you rely too much on the person doing the quantifying, which is, in this case, could be the planner, and their experience pricing every tactic along with available supporting research. But again, with reliable data and good planning team, this method works very well. It certainly worked very well for me. So now let's work on this example. A major CPG company is preparing to launch a new line of skincare products. They're doing a test in 2 test markets, Greensboro, North Carolina, and Lexington, Kentucky. This is what the agency is costing out per market, which will be presented as a package marked up with a 15% agency profit. So let's look at all the materials needed. So here you're putting, let me write everything So this is production of, let me put here production. The other one was a production of TV and radio. We have airtime of TV and radio. We have brand ambassadors, which are in store, you know, giving samples or, you know, coupons. We're going to be doing radio remotes for these two tests. And we're calculating how many man or women hours is going to take for this effort. So let's put agency hours. Okay, so we have several things here. So this is going to cost $35K. This is going to cost $25K. The airtime is going to cost $50K. The brand ambassador, we're calculating $10K. And the radio remotes, also $10K. And the agency hours, $15K. So these are, again, you call different vendors, you call, you know, you have cost per point and cost per thousand that allows you to calculate airtime. Your agency is probably going to take care of the production, so you ask the production team. You need an outside vendor to take care of the POP, POS merchandise for in-store. The radio remotes obviously is tied to the airtime negotiation, so this you have to talk to media, to our radio stations in the market in order to calculate. And then the man hours, that's, again, you know, you doing your own math to see how many hours this is going to take. So again, using the objective task method, you calculate the total budget and you present it to the client with the profit. So the first thing you do is step one, you add all the tactics, the production of the POS at 35, the television, commercial, and production at 25, the television and radio airtime at 50,000, the brand ambassadors at 10,000, radio remotes at 10,000, and agency hours at 15,000. So that gives you a total of $145K per market. And you are running this test. Again, typically testing is done in test markets to see how things go, and then you launch nationally. So in this case, we're doing only 2 test markets, and this is the cost per market to do the test. So you were looking at 2 test markets, so the total budget is $290,000. So again, adding everything times 2. So now we're gonna go and we're gonna calculate the profit. So the profit in this case, we're gonna keep it simple. For example, when I was doing this in the agency where I worked, every time I had to do this type of calculation, the agency, for whatever reason, this is the percentage they gave me, is marked up 33%. Why 33%? I don't know. Administration basically felt that that was an acceptable profit margin for everything that we were doing for the client. So in this case, we're going to say that the agency wants to make the traditional 15%. So remember, 15%, you have to divide 15 by 100 to get 0.15. So you calculate times 0.15. Let me change color so it's a little bit more clear. So now we're calculating the package, right? So now what we do is 290,000. This is the net. This is what's going to cost. The profit for the agency is calculated at 15% or 0.15. So the profit is going to be for the agency, this is what they're going to make on this effort above and beyond. Again, this may vary. The agency may say we want to make 5%, so they don't want to price it too expensive. So now that we know that that commission or that profit is $43,500, we're going to go into calculating a total gross budget. So all you have to do is add your 290,000 and you add the profit. So what are you presenting to the client? 333,500. So you're presenting a budget, a total gross budget of 333,500 in order to run this test for into markets to basically promote this particular line of skincare. So now, hopefully this is clear, but this is a very simple. Again, this is one that I use very effectively at some point in my career. So let me erase. Let's go now. Let's go now to the affordability method to set budgets, which is a very top-down and simplistic. Again, you're building your budget from the top down. And in this particular one, you have to look at profit margins of the product, and you have to decide and calculate how much margin the client can afford to allocate the advertising investment. This method is tied to profitability of the product and calculates what is called a payout point. So let's keep building in this example. With this method, you need to ask the client for more information on their profit margins in order to be able to calculate a payout point. And you also have to ask for sales data. So in this particular case, the client is being presented a budget to advertise or test market. These two, in these two markets, they're launching a test for this new line of skincare, and the budget that is presented was 333,500. So in this particular case, you're presenting a budget of $333,500 to test the new line of skincare in these two markets. And they're currently selling 250 units. So this is how much you're selling without advertising between these two markets every month. The profit for each unit sold, and again, these are numbers that the client will give you. We're making them up. But anyway, the client will tell you that they make $1.25 for every unit sold. So the question becomes, how many more units do they need to sell with this promotion to pay out the 300, this figure, okay? So the first step is, let's look at the numbers. So the client approved this budget on sales promotion. The client earns $1.25 of profit for each unit sold, and they're currently selling 250,000 units every month between the two markets. So those are your stats. The question again becomes, how many units do they need to sell to pay out for this investment? So let's do the calculation. So basically what you first have to do in order to calculate the payout point, let's change colors. In order to calculate the payout point, you divide the promotional budget into the profit per unit to calculate how many units this investment represents. So now what we're going to do is calculate the payout point, which means that you're going to divide your promotional budget into the profit per unit to calculate how many units above and beyond the investment this represents. So we're going to take the budget presented of 333,500 and you're going to divide it by how much they make per unit. So this represents 266,600 units. So technically what this means is that they would have to sell for this investment 266,600 additional units above and beyond as a result for this investment. So the next thing that we're going to talk about is now let's calculate this payout point in percentage format. So now what we're going to do is divide the increased units by the number of units currently sold multiplied by 100 because this is presented in percentage format. So let's do it in another color. Go back to pink. So we're going to take the 266,000 additional units divided by the 250,000 units that they're currently selling. It gives you 1.06 times 100. That becomes 106.6. So let's round it up to 107%. So, let's report these numbers. So technically, with a promotional investment to test market the new line of skincare of $333,500 and at current sales levels of 250,000 units between the two markets every month, making a profit of $1.25 for every unit sold, the company needs to sell an additional 266,600 units, or almost double sales at 107% over current sales level to recuperate this promotional investment, hopefully more. So now let's move to percentage of sales. So the percentage of sales budget setting method is a very simple one because it involves multiplying the total sales volume by a fixed percentage to arrive at the budget. The method uses sales volume of the previous year or projected sales within a specified period, and that fixed percentage used could be company experience or history, the industry average, however you define that percentage. The upside of this method of budgeting, besides its simplicity, is that it's an informed budget recommendation based on solid data rather than subjective judgment. So let's look at the scenario in the numbers. So let's say that the CPG company skincare division is selling approximately $60 million nationally, meaning across the U.S. They want to allocate 10% of their sales into advertising, and they want to divide it equally among the top 10 markets. What is the projected annual advertising budget using the percentage of sales budget setting method? How much does each market get allocated? So let's look at the number. The current sales levels for this company, so sales annually, nationally, is $60 million, right? And they have a total of 10 markets. And they want to allocate the percentage to sales percentage allocation is 10%. So they want to allocate 10% for marketing and advertising. And this 10% is 10% of sales. Remember that, they had a profit margin of $1.25 for every unit sold. So now here, the question to answer is, what is the projected annual advertising budget using the percentage of sales method, and what is the budget allocation per market? So now let's go to part 2. Let's calculate this advertising budget. So this is very simple. The current sales level are $60 million, and they want to allocate 10% of these $60 million into advertising and marketing. So very simple, 60 million times 0.10, or 10% divided by 100 is $6 million. So it's 10% of the 60 million in sales. And then how much does each market get allocated, because they want to divide it equally. So now it's a very simple division of 6 million divided by the 10 markets, and that equals each market is gonna get a $600,000 allocation for each individual market for sales and marketing. As a side note, again, with any method, you may want to calculate a payout point if you know the profit margin per unit to understand how many more units do you need to sell to recuperate that advertising investment of $6 million. So now let's go to the last budget setting method we will look at. So the last budget setting method we will look at is the competitive spending method. And this method looks at spending history of competitive companies for the purpose of determining your own budget recommendation for your client. For this method, though, you need good and consistent source for tracking competitive spending or competitive media spending or advertising spending, and an internal agreement of who is considered competition. There are syndicated sources of research to track spending and advertising activity. The questions here to ask is how much is your competitor spending, and calculate your budget relative to that figure. You may want to compare the competitors' advertising spending to their total sales as well. So let's say that your closest two competitors make an average of $25 million each in revenue, and their typical advertising investment ranges between 5 and 8% of that budget. Your client, meaning the one you're working with, their average sales revenue is $12 million. So now what we have to do, let's put these figures here. So your competitors, they make an average of $25 million in sales. So this is your competition sales. They make $25 million. Their percentage of spending in advertising and marketing ranges between 5 and 8%. And your client makes, meaning the one you're working on, client, their annual revenue or sales is $12 million. So now the question is, how much is your client's competition spending on advertising, and what is the recommended advertising budget using the method of competitive spending? So we already looked at the numbers. The sales of your two closest competitors is 25 million each in revenue. Your typical advertising investment ranges from 5 to 8%, and the question to answer is, calculate an average of competitive spending. How much is your client's competition spending on advertising, and what is your recommended advertising budget using this method of competitive spending? So now in this step, what we're going to do is calculate the average percentage and average advertising budget for the two close competitors. So this is very simple. You add 5 plus 8 equals 13, divided by 2 is 6.5%. So this is your average percentage to sale that your competition is spending on advertising and marketing. With an average sale of $25 million, you multiply $25 million times 0.065, because it's 6.5 divided by 100 is 0.065. So how much are they spending in advertising and marketing? At 6.5% of annual sales, let me put it in another color, what they're spending in advertising, again, this is directional and it's an average, is 1,605,000. This is their average advertising budget for competition based on percentage of sales, which is an average of 6.5. This is what you're guesstimating. So this is how much the client's competition is estimated to spend on advertising and marketing. So now the other one that we need to do is calculate your own clients. So based on this particular competitive spending budget method, okay? So your client is making $12 million, and the average your competition is spending on advertising and marketing is 6.5%. So again, divided by 100 is 0.065%. So that means that your client, the recommendation, if you're going to use the average done by your competition, you multiply unit sales times an average of what the industry of your competition is spending. So 12 million times 0.05, which is 6.5 divided by 100, you're recommending for your client to spend $780,000. This is how much you're spending. Again, the side note is that this method has its own limitations as well, since you're using data coming mostly from monitoring and, syndicated sources. These limitations are that projections imply a margin of error, and that estimate expenditures for competitive media spending is established by using standard media pricing, which may also carry a margin of error. So it's all tying back to the data that you have available. This specific budget setting method needs good data, again, and it may be an estimate, but good to understand that you can use the competition to guide budgeting. Those were 4 very distinct methods and scenarios used to set budgets. And by the way, I have used every single one of them. Also know that in all 4 methods, you can add an additional layer of protection for your clients, and they will appreciate it. And that is to calculate a payout point and quantify how much more they would need to sell with the advertising and promotions investment to recuperate that advertising investment and establish a threshold. Another measure you can do is ROI after, you run the campaign and you get results. Managing clients' expectation is always key and very important to have metrics or KPIs to establish those levels of accountability. So that's it for now, and I will see you in the next video lesson.